Good afternoon, everyone, and welcome to today's webinar, Avoid the Biggest Tax Mistakes Tech Executives Make with Equity. I'm Tina Powell, partner at Intentionally, and your moderator for today's session. It's truly a pleasure to be here with you and to introduce our distinguished speakers from Wealth with Options, Jackie Lewis and Ryan Goldenhar, whose firm is based in San Diego and serves technology professionals nationwide. Before we get started, a few housekeeping notes to help you get the most out of today's session. Number one, this session is being recorded. All registered attendees will receive replay via the email address you used during registration. Number two, this presentation is educational in nature and is not intended as personal financial advice. For guidance tailored to your unique circumstances, please consult with your financial advisor. And number three, Jackie and Ryan are offering a no commitment complimentary consultation of your current equity compensation package. If you would like to book a conversation, please head on over to wealthwithoptions.com/contact-us to get on Jackie's calendar. Now, let's meet our speakers. Jackie Lewis, CFP, MBA. Jackie specializes in helping tech professionals decode their equity compensation like it's written in plain English. Spoiler alert, it's not. She brings clarity, confidence, and just the right amount of caffeine to every meeting. She's part advisor, part translator, and part therapist when the markets get moody. Whether you're swimming in RSUs, wondering what your ISOs actually mean, or just trying to avoid a surprise tax bill, Jackie's got you covered with a smile and maybe a spreadsheet or two. Jackie understands that stock compensation isn't just about the numbers, everybody. It's about life goals, career transitions, and making smart decisions at pivotal moments, which is what today's webinar is all about. Whether you're preparing an IPO, evaluating a job offer, or planning your next move in a fast-paced tech career, Jackie brings clarity, strategy, and personalized guidance to every conversation. Work with Jackie to turn your equity into opportunity and have a little fun along the way. Speaking of fun, a fun fact, Jackie enjoys her 3 adult kids volunteering at the Ronald McDonald House, hiking and running outside, as well as Orange Theory. Welcome.
Thank you.
Jackie, how are you doing today?
Doing great. Thank you. That was a nice bio, Tina.
Good, wonderful. Well, Ryan Goldenhar is up next, CFA, CFP. Ryan has spent many years working with financially successful individuals and families to help them manage their wealth through a variety of economic environments. From this experience, he's come to understand how emotions impact financial decisions. Investments generate huge emotions around fear and greed, especially when the market is volatile. Ryan co-founded Wealth with Options to help clients succeed on their terms and live their best lives. Ryan's worked as a portfolio manager for a large private bank for over 12 years, helping very wealthy families preserve and grow their wealth. Now he enjoys bringing this experience and private bank level service to Wealth with Option clients as they embark on their wealth journeys. Fun fact about Ryan, everybody, is that he is a proud husband, a father of 2 teens, an avid Padres fan and history buff who loves to travel. Disney, Marvel, DC Comics, Star Wars, Off the Wall, which I love that. I love that album still, and classic 1980 videos games. Welcome, Ryan.
Thanks so much, Tina. It's great to be here.
Great. And with that, everybody, let's get started. Jackie, the floor is yours. Really excited. I know that you want to introduce today's agenda before we get started.
Yes. Thank you, Tina. And welcome everybody to our webinar. As Tina mentioned, I'm Jackie Lewis, and I'm one of the co-founders at Wealth with Options. And really, today we want to talk about equity compensation and why it matters. And so, for a lot of you, especially if you've just received equity or it's your first time getting it, it can be a little overwhelming. There's a lot of different acronyms, different tax treatments, depending on what your grants are, and it's complicated. And so, some people really don't understand it and just kind of continue to think of it as play money. But honestly, we really think of it as a strategic asset and that it really deserves planning around it. Obviously, you're getting a salary and you're getting a bonus, but your equity can be multiple times what those are. So it is really important, and that's why we want to talk about that today. We'll talk about some of the mistakes that we see out there, and more importantly, how to avoid them. A lot of people that we talk to are really concerned about making a mistake, and it causes paralysis, so they do nothing. And so, again, lots of different ways to plan around your equity, and we're going to talk about that today, as well as best practices. What are some different strategies that you can utilize to not only help minimize your taxes, but maybe help diversify a concentrated stock position? So, we'll talk about different steps that you can take in order to put a plan around it, and then we'll end our webinar with just some Q&A. So, as you have questions as we go through this, feel free to put your questions into the chat box. Hopefully we cover it within the webinar, but if not, we're going to address those at the end. Tina?
Thank you, Jackie. And I think a natural place for us to start off, Jackie, is why does this topic matter in the first place? And why is it so important to have this conversation now?
Great topic, Tina. So, as we mentioned before, when you're working for a company, you're employed by them, you're getting paid by them, and now you're getting equity in the company. You really have all your eggs in one basket. And so that involves risk. And equity is a great place to maybe reduce that amount of risk. So we're going to talk about that here in the webinar. And then taxes. If you want to minimize the amount of taxes that you're going to pay on this equity, you really do need to put a plan around it. There's a lot of different strategies that we're going to be talking about. 83B elections, tax loss harvesting, giving money away to charity, a number of different options. So we'll talk about what those are. They're not all going to apply to you, but there will be some. And I think educating yourself on what's out there and what you can do is a big part of it. And the other reason is we see a lot of clients that maybe are waiting for a liquidity event to occur. And that can lead to some surprises, AMT taxes, maybe a big tax bill, and that can be avoided. And so we'll talk about maybe starting early, being aware of what you have, starting to put a plan together, and then walk you through the different steps that are out there that you can take. Tina?
So, my next question is for you, Ryan, and that is how should smart executives approach equity compensation as a strategic asset?
Yeah, no, thanks, Tina. It's a complicated situation, and it's interesting. Many of our clients that have equity compensation are highly intelligent, very good at what they do. They've gone to some of the best schools, very professional, very detail oriented. And then we talk to them about their equity compensation. We find there's no plan, there's no insights, and maybe they don't enjoy it, honestly. And I think hopefully it comes through in this webinar today. But we really do enjoy this topic, and not every client is going to enjoy it as much. But I think the concept here for this slide, what we're talking about here, is to really put a discipline around what you have as far as equity compensation. Know what you own, when it will vest, how much will vest, on what particular calendar years, and then put a plan as far as when to sell. Is it the right time to sell now? Is it right time to sell at another time? Do you never want to sell? Just talking those things out loud. Sometimes they have no one else to turn to besides maybe a coworker, spouse, friends. And that may not always be the best advice. And so it's good to bring a neutral party who understands what these things are to really put a plan around it. And then not only just have a plan. One thing that's really important with this is the plan is part of it, but executing on the plan is probably the most critical. And that's where we find a lot of clients, even if they've done a one-time financial plan, they're not actually holding themselves accountable to actually implement as time rolls on and as situations change, both with their equity vests and grants, and then with the market conditions as time goes on.
So, speaking of plans and speaking of mistakes, I know that Jackie is going to lead us. And this is really important for our audience today, is that I know that we have the different mistakes that people make as it relates to their equity compensation. So, Jackie, do you want to walk us through the first mistake, why treating equity like extra money is considered that first mistake? And how does this mentality, unfortunately, lead executives to tie too much into one stock?
Hmm. Yeah, thanks, Tina. Yeah, no, it's really important that you become strategic with your equity. We do see a lot of clients out there that maybe treat it like extra money, but again, I mean, you can use your equity to be a foundational piece of your balance sheet. We see a lot of clients that have built their wealth through the equity. And so procrastination or delaying what you do with your equity can have consequences. It creates a concentration, and you can run into some problems with that. So we really want to look at a client's life goals, their cash flow. What's coming up? Do they want to buy a house? Do they have college expenses coming up? Do they want to fund a 529? How do we bring that into the picture as we're looking at the equity and when we can, potentially sell it and take care of some of that? We're also looking at the tax side of things. And a lot of times our plans are multi-year. So, we'll check, is your spouse taking a sabbatical at some point? Are there carry forward losses on your tax returns? Because really paying attention to these things can reduce the amount of taxes that you're paying on the equity when you do decide to sell it. And we have a wide range of different people out there. Some are very attached to their company stock, and some are a little fearful of it. And so, as we say, if you want to grow your wealth, you continue to kind of concentrate into one stock. But if you want to maintain your wealth, you really do need to take plans to diversify it and have a sustainable portfolio as well. You can have both, and it's really about putting a plan together around both of those. Everybody's going to be a little different. We're going to talk about risk tolerance, about tax brackets, and so forth. But you just want to have a plan so that you get started with it and not be afraid to kind of jump in and put a plan around it. Regret minimization is a real thing. And so, we talk about what happens if the stock goes way up, which is a
Mm.
great thing. But what if you sold some? Are you going to regret that? Vice versa. What if it goes down? Are you going to regret that you didn't take some money off the table and sell some shares if that happens? And so, it doesn't have to be all or nothing. We really talk about what percentage is going to make you comfortable and go through the different scenarios so we can get to that spot where everybody's a little more comfortable with the plan going forward. So,
It makes a lot of sense, Jackie. And one of the areas, again, that you picked up on, in the key word here being taxes. And Ryan, I would love for you to tackle this question. Why is it so important to plan for taxes before shares vest or options are exercised?
Yeah, no, I'm glad you brought this up. And so I think as you're seeing with Jackie's comments from the last slide is what we do with clients, and we work together as a team on all the client calls. So they get both of us, but it's really doing thought exercises. We don't necessarily say prescriptively, this is what you should do. I mean, we will have recommendations when we look at a client's situation, but we also engage them in helping come to their own conclusions about what's best for them. And it's a spectrum. It's not binary, one or the other. So where we're going with taxes as a thought exercise, where I was going with that is with a thought exercise, what if taxes weren't even a thing? Well, there still might be a hard decision to make about what to sell, when to sell or not, But if taxes are removed, I think a lot of what we're talking about may be pretty simple. I think what makes it more complicated is the taxes. People wonder, did I do an 83B election, which we can talk about what that is. An 83B election allows the vesting schedule allows vesting to start and allows tax treatment to be a bit different, which is nice, but maybe it wasn't filed, or maybe it was. Maybe they didn't keep a good document. Where do they find that? Or what about a 10b5-1 selling plan? A lot of clients don't know what that is, and that's sometimes clients have found that the best time to sell stock if they wanted to was outside of a quarterly trading window. Well, how do you do that? Well, that's where a 10b5-1 trading plan may be something to consider. And then how do you structure it with certain prices? If the stock hits certain prices, would it execute? Would it not? How do they put that in place? How often do they do it? What happens is there's all of these various things that happen each calendar year and sometimes each quarter that brings up something to talk about with a client in this regard. And what's very important too for clients is both the beginning of the year to lay out the plan. What do they want to do? Do they want to exercise some options? Do they not want to exercise some options? And at the end of the calendar year, each tax year serves as its own mini microcosm as part of the client's long-term journey. And taxes are the main reason why. We help to say, what would the taxes look like for this year? Look at the pay stub. Where are you year to date? And make sure that enough taxes have been paid. Some things that clients don't like, even though the taxes may be appropriately an amount, what they might find is come April of the following year, the tax bill that their CPA says they have, or that the TurboTax says they have, is way more than they expected. And maybe they don't even have enough cash to pay that tax bill. We really want to eliminate surprises where possible. And one of the top ones for us is to say, let's work with your CPA, let's work with your tax provider to say, and do some modeling together about what will the tax bill be in April, so you have the cash set aside. You're not selling something or needing to sell something that you can't sell to then pay the tax. And the last thing I want to mention, Tina, is there's differences between private companies, and a lot of our clients do have private company stock. Some of the most valuable companies in the world are private. And then how do you get liquidity? Maybe there's a tender offer, maybe there won't. Does it have double trigger vesting? What does that mean? So being aware of when that might happen and being prepared for those tax bills when they happen and how much to tender if they want to tender for those private shares, whole different set of situations to talk about for private shares than we do for publicly traded companies, where there's a whole set of SEC guidelines and tax rules that we have to follow for publicly traded companies.
Ryan, that is a comprehensive set of information there, right there, which again, I'm really glad that we're having this webinar right now. Back to you, Jackie, and this idea of these concentrated stock positions. Why is it so hard for tech professionals to let go of a concentrated stock position, even when the risks, the ones that, Ryan and you have both laid out, even when the risks are crystal clear?
Mhm. No, it's real, Tina. I mean, people get very emotionally attached to their employer stock. And a lot of it is, they're working at the company, they're working hard. They see where it's going. They're excited about it. They're in a team of people that are also excited. Generally you'll see senior executives very bullish on the company stock. And so, all of the information that they're getting is positive, and it leads them to really want to hold on to their stock, which we understand. But with that does come risk, as you mentioned. And so it really, I think, helps to talk to a neutral third party that's not in the company, that maybe has a more, impartial view of not only the company stock, but just investing in general, and really trying to figure out how to, really minimize the risk of a concentrated stock position. So, you don't have to sell all, you don't have to sell zero. There's usually something in between in that range that you're comfortable with. And if you're not sure, I mean, Brian mentioned a 10b5-1, you can set it up on auto, right? Where you can set up a plan at the beginning of the year and even have the ability to sell outside of, trading windows. So it really is different for each employee, but really putting a plan around it, and around the stock price is a huge help to just slowly take some of that concentration off the table. And you can still really believe in the company, and still
Yes.
diversify.
Right. And I love the word, I love the modeling also too that Ryan described as part of this. And Ryan, back to you. Again, covering a lot of amazing information here right now, but there are primary distinctions between the two types of stock options. So really eager to hear from you what those are.
Yeah, no, it's great. And yeah, I think back to when we first began working with clients in this particular space. It was back in 2020 during the pandemic times, and we encountered incentive stock options. And what's interesting is incentive stock options are one type of stock option that you might be getting from your employer. It's a very tax preferential potentially. And I say potentially, it may not be, it depends on the situation for the client. And then there's what are called non-qualified options, which is different. And they're treated differently for tax purposes. It's part of the reason we've named our firm Wealth with Options. It's because of these two different types of options. And it gives you lots of choices. And choices are nice. Freedom is nice, but it does create some analysis or paralysis by analysis, where ultimately there's so many different things. And so I had worked as a trust portfolio manager, as you said in my bio, for over 12 years and not really encountered these that much at that time. So when we came into the 2020 period and we were encountering many tech executives that were getting very wealthy at that time from their company stock, we had to take a look at these different options and help clients understand. I'm a former teacher, help them understand the differences here. And the main difference between the two is this thing called alternative minimum tax, which you see on the slide, AMT. And if you're not aware of taxes and the tax code and how it works, we're not going to bore you with all that here or even in a meeting. But essentially, there are two different calculations that are run every year, whether you know that's happening or not. For most people in this country, they fall into the regular tax system. But there's always this alternative minimum tax calculation that's running side by side every year. And in a situation where the alternative minimum tax amount is a higher dollar amount than the regular income tax that you might pay, you're going to fall into this alternative minimum tax. And one of the drivers of that is exercising incentive stock options. So the difference between your strike price, what they were granted at in the incentive stock option, and the price of that stock when you exercise, that's called a benefit value. And that benefit value, it's basically phantom money, but you're going to pay potentially real tax dollars on that benefit value. And December 31st is a critical point because if you are having this huge benefit value and trying to get this lower long-term capital gains tax rate on that benefit value, it requires doing certain things, holding the stock for a certain amount of time. And as a publicly traded company, if it is publicly traded, you're going to have to deal with those 5 days a week, numbers of hours a day, watching that stock price wiggle and sometimes wiggle a lot, trying to get a lower tax rate. Now, that's a good thing. We want to model that out and make sure that is it worth the money to do that? And if it isn't, there is what's called a disqualifying disposition. But that needs to be done if it is a publicly traded company and you are still working there. You need to do that while you're working. You need to do it while there's a quarterly trading window open. And if not, if you're still holding that stock post December 31st, there may be a tax bill due in April. And who knows what the benefit value or the stock price might be at that time. A lot of information I'm sharing here just to kind of set the tone of how important this is and how important it is to keep track of these prices, keep track of what you own. Did you exercise? How long did you hold it? Because a lot of things can go in a direction that's, again, an unexpected tax surprise or an unexpected financial hit that you don't necessarily want, that we want to make sure that you're understanding both pros and cons, ups and downs, and set the expectations appropriately and what we can do at certain points depending on what the stock price does and where we are in the calendar year.
Thanks for that information, Ryan. I think you're leading us off into mistake number 5. Jackie, another question for you again, and Ryan's hit on part of it, is not having a tax efficient exit strategy in place. Why does this matter so much to tech executives?
Mhm. Yeah, great question. And, once you actually sell some of your company stock, now you have proceeds. And it's really about how do you put these into play in a very tax efficient way. I'm going to talk about 3 here, but there are many, many other strategies, and not all of them are going to be applicable to you in your specific situation, but some are. And so I think just being aware of some of these different strategies is really important. and talking to your advisor about which one is going to be most applicable to you. So, one of the first ones that we normally talk about is uh, direct indexing, and it's really just a way of investing in a very tax efficient way. So, big picture, it's really about making sure that when you are investing, that you're taking advantage of being able to accumulate losses during the year and yet still get an index return at the end of the year. So rather than maybe going into an index ETF, you can actually create your own index with several hundred different stocks. And so throughout the year, as maybe, some of the stocks are losing money, we actually harvest that loss. We put those returns back into a very similar type of stock. And then at the end of the year, as you go through all of these iterations and volatility in the market, you'll get whatever the index is at the end of the year. And it could be, S&P 500, Russell 3000, a lot of different ones you can choose from. But you'll get the index returns as well as these accumulated losses throughout the year. And if you've sold some company stock that year, you can actually offset those capital gains tax with those losses. So it's very tax beneficial, and just an important way to invest if you're not currently doing that. One of the other strategies is a donor advised fund. We call it a DAF. You do need to be charitably inclined if you want to go down this road, so it's not for everybody. But it does provide tax deductions during a year. If you're selling company stock, it's a great way to kind of offset again that capital gains tax with a charitable deduction. The positive things about a DAF are once you put the funds into that DAF, you don't necessarily need to know which charities you're going to be donating to, how much to each charity. You actually have multiple years to make those decisions. So it really just gives you a bucket to put charitable funds into in the year that you sell some of your stock so that you can get that deduction. And then down the line, you can figure out, how you want those charitable deductions to be sent out. The third one I want to talk about is called QSBS. It's a qualified small business stock, and it's not going to apply to everybody, but if you are with a small company, and it's got to be under 50 million in assets, so fairly small. Once you get equity in the company and then the company starts to grow and build and appreciate, at the point when you finally decide you want to sell some of that stock, and generally we recommend that you hold it for 5 years in order to get the benefits, you can actually protect, used to be up to 10 million, and as of July, it's now 15 million in taxes that you don't pay if you follow the rules. Again, it's got to be under 50 million in assets for the company, and you need to hold it for 5 years, among other things. But it is a wonderful strategy if it works for you in your situation with your company. So again, just really important things that you need to be aware of with regards to the various strategies that are out there to help you minimize taxes. Thank you.
And Ryan, along those lines, I know that you wanted to introduce some core equity tax planning best practices.
Yeah, and I know that this is a live webinar, but it will also be recorded. And if you're watching this as a recording, I'd encourage you to freeze this slide so you can take a look at it. It's got quite a bit of information, and the next slide that you're going to see has quite a bit of information too. But what I'll do is categorize these three headings that you see on this slide as what, when, and what if. So on the what on the top part of the third here is really know what you own. They're all different. And we've encountered all of these. Restricted stock units, what are they? How does it work? And how much taxes do you pay? The biggest issue we find with the RSUs is maybe not enough taxes were withheld out of your paycheck. And then that's where you get a tax surprise come April. And then you have to maybe pay penalties too. So those are RSUs. There's non-qualified stock options, NSOs. And we often think of those in a different way than we do the incentive stock options I talked about earlier. Those are not as tax preferential, but they can be still used in a client's life goal, which I'll hint on in a moment. Then there's the incentive stock options we talked about, more tax preferential, harder to get, but when you do have them from your company, they can be very valuable. And you may have to exercise them before you leave. So that's another factor to consider too with incentive stock options. Otherwise, they all of a sudden turn into non-qualified stock options. And many people don't necessarily know that. And then the ESPP, the Employee Stock Participation Plan. The tax treatment for those works like incentive stock options. And a lot of people want to participate in those, and they can be quite attractive to do that. And that's in addition to a 401k and other types of places that you put your money from your employer paycheck. But that could be one to consider for clients as well. So that's the what. The when is plan ahead for the timing of when you're getting these things and how do you want to plan around taxes. Every year is a fresh template, a fresh canvas for you to paint your tax picture for the IRS, and you can fill those buckets however you want. And we try to take advantage of each of these tax years, each calendar year, to say how much do we want to fill in it. And some years you're already doing so great at your employer that you're filling those buckets all the way to the max. And the last thing you want to do is fill it even more to the max and pay some high tax brackets. So we want to then do the what if in the last third, which is what are your goals? We found a lot of clients want to take a sabbatical, 6 months, 9 months. Maybe they want to be an entrepreneur and they're trying to use this as their grub stake to put down to start their company. Whatever motivates them, or maybe they want to retire early, financial independence, retire early, or coast into this. They want to work part-time. They want to go into a different career path. We take all of these different things that every client's different and say, how do we then incorporate what you've got in equity and what you've got in taxes and and turn this wealth and align it to help you get to where you want to go. Money's supposed to have a purpose, and it's not just supposed to be digits that move around on a computer screen. It should be really aligned with helping you live the best life you can.
And Jackie, I know that there's some things that you want to add on to what Ryan said. Really great information here.
Right. Brian, did you get through all of the best practices?
Well, the best practices, if that's where we're at on this, is really there's all of these different things that we're going to explore. And so we want to, as best as possible, find ways to reduce taxes. And everything we do is legal. Just make sure to mention that. What can we do to bring you into lower tax rates? We are at some historic low tax rates here in 2025 under the new tax law. And how do we want to maybe accelerate paying some tax? That's something you don't often hear. But sometimes it makes sense to pay taxes now. It's like we're on a toll road, and the IRS is going to charge us at different amounts of money depending on where we are on the toll. And maybe this is a very low toll rate, and maybe we want to pay some taxes and then have what's left now under these tax regimes, then future years where we may not know what the tax rates are. In fact, we don't know what the tax rates will be. So we want to maximize how much of your vesting and your equity would be under what's considered long-term capital gains, which is lower than ordinary income rates. Offsetting your gains with other things like Jackie talked about, with direct indexing, where we can find ways to generate capital losses while still giving you index returns. And that's the nice thing. And so it's kind of walking downhill both ways in some ways of thinking about what that is. And to give smart, not just generously. If you have equity and that's been vested and it's highly appreciated and you've held it for over a year and you're writing a check to your favorite charity, that may not be the best way to give money to the causes you're most passionate about. It may be better to give some shares of your company and avoid the long-term capital gains tax it entirely and give that charity the full market value benefit of your donation. So we help with clients to do that, to move shares to where they need to go so that your charities get the most from the assets that you might have. And the qualified small business stock exclusion, that's one that Jackie mentioned. And it's a really nice part of the tax code if you can qualify. Not many people do. And I wondered until just this year what Congress and the president administration, what they would think about this nice tax benefit. Well, not only did they retain it under this tax law that was passed in July of 2025, they enhanced it. So we can talk about how they enhanced it, but at bottom line, it is a very nice thing to explore. And if you potentially have access to this as part of your picture, we want to make sure to explore it and get the proper documentation to do that. And then getting your whole team together. We know we are an advisor, but we're not going to prepare your tax return. We're not going to draft your estate plan, but those are important pieces to think about too, and to protect these assets, to have the proper property and casualty insurance because your net worth is really expanded. We want to make sure your team is all working harmoniously around your particular goals and to interface with all of them. And so this isn't about luck, as the last point here about the takeaways. This is really about putting a plan together. And nobody plans to fail, but some people do fail to plan. We really want to make sure our clients are not those people. We want to make sure that we're holding them accountable, we're detailing their goals, and we're keeping track of it as time goes on.
This has been really great, essential information here, Ryan and Jackie. I would love for us to leave our attendees with some key tech takeaways. What are some best practices and action steps for them?
Yeah, I'll take that one. Yeah, I mean, basically three things, right? You want to track it, you want to tax plan it, and then you want to diversify it. So, really, the first step is understanding what you have. What have you been granted? What is this equity? And more importantly, how is it going to be taxed? Because as we've mentioned, different grants are taxed in different ways. You don't want surprises. Those are no fun getting tax bills out of nowhere. So, you really do want to work with your, advisor and your CPA to put a plan together and make sure you understand how you'll be taxed, and more importantly, how you're going to handle the taxes. Um, Second, you really want to put together some sort of a diversification plan. You don't want too much concentration, and everybody's comfortable with a certain amount, but you do want to diversify at some point, and you want to plan for when you're going to do this, how much you're going to do this, at what time, when you're going to sell it. We talked about a 10b5-1 plan where you can automate it to some degree. But really, it's about having these conversations. And again, it can be around, your cash flow needs and your life needs as well. And then, once you sell, how do you invest? So there's a number of different steps. Those are important. And then the third one is you really want to coordinate with your various life events, whether you're buying a house, funding a 529, maybe you've got college expenses coming in. When are you actually going to need that liquidity? And it's important that we know that ahead of time so that we can plan for that as well. You want to match the sales of your employee stock with your life goals. And then fourth, how do you leverage some of the tax efficient tools that we've already talked about? 83B elections, charitable giving, direct indexing, QSBS. Where do those fit into your plan? And make sure that you're implementing them at the appropriate times. And then lastly, you want to assemble your advisory team. So whether that's, your CPA, your estate planning attorney, your advisor, you really want to coordinate with them to make sure that all of the various pieces of your plan are timed correctly and that you're, working with people that can help you minimize taxes. And with that, Tina, I think we can go into Q&A.
Yeah, thanks, Jackie and Ryan. I have some questions. I'll start off with the first question. When will I owe taxes on my RSUs or stock options?
You want to take that one, Ryan?
Sure. So for any vested restricted stock units, RSUs, if you get those during a calendar year, your company will withhold a certain amount of federal income tax on the benefit value, how much it's worth at the time of vest. And you'll see that on your pay stub. If you're making under $1 million at your employer for the year, the federal government only requires your employer to withhold 22% for federal income tax. So what you might find is if you're in a higher tax bracket than that, 35, 37%, that's the extra money that you're going to have to pay the following April. Now, it may make sense for you to avoid a penalty to pay some portion of that during quarterly uh, tax estimates that you might set up with your CPA so that you don't have a penalty. So you give the government some of the money that they're due next April now. It all depends on what your fact pattern was the previous tax year, whether your safe harbor is, which we take a look at for clients, how much should they pay based on last year's taxes that they paid to the government, and maybe it makes sense to just wait until April. It all depends for restricted stock units. For options, well, the nice thing about options is they have this 10-year window that you can exercise them in, and you can wait and wait and wait and wait. And nothing's wrong with waiting. It may be the best decision, but let's understand all the potential drawbacks of waiting to do that. We often will say for a client who is getting burned out in their company, they're enjoying the work, they're getting very well compensated, but we find they're very stressed and they're looking forward to maybe taking some time off after this job and then looking for their next opportunity. And if that is part of this particular client's fact pattern, we talk about sometimes using these non-qualified options as a potential little golden parachute. Why not in a gap year where you're not having nearly as much income, so you're taxed at a lower rate, then exercise them then if you feel like the company can last well at the stock price through that point, and then fill that income bucket with some of that exercising options, turning it to cash at those times, pay lower tax rates, and then nice golden parachute from a lot of hard work at your company and taking that reward at that time.
There's another tax question coming in, you guys.
Mhm.
Can I time exercises or sales to reduce my tax bill?
Yes. Timing is really important with taxes. And so, depending on what type of a grant that you got, yes, timing is important and it will make a big difference in the amount of taxes that you pay. So, we're constantly looking at where are we in the year as we're getting towards the end of the year. Do we really want to sell something when we're just going to create a tax bill in April, or can it wait until January, at which point we have a whole nother year and 4 months before taxes are due on it? So it is something that we look at. Same thing with, when you're exercising some of these options. What is the stock price at? Has it gone up? Has it gone down? When is a good time to exercise? Timing, again, really important. And how long do you have to hold these particular shares? So, yes, it is very important, and it's definitely something that you want to plan around. And in every case, it really does depend on the type of option that you have.
So this next question I really love because I think, especially for tech professionals in the age of AI, I imagine that there's going to be an increase in IPOs over the next 1 to 3 years, especially. Here's a question, Jackie and Ryan. How should I set aside for taxes after a liquidity event or an IPO?
Ryan?
Want me to take that, Jackie? Yeah. So I think initial public offerings are an exciting time for a company. If your company is going public, you may have been waiting for this for a very long time, and it's a real marker of success for a company to get to that point. And it could happen also just through an acquisition of your company by another company, which creates the same problem, which is problem. These are the good problems to have in the world, where all of a sudden, your equity that had a certain value on paper and it's paper wealth, and maybe you're not even thinking it's real wealth until it turns into cash, which is not a bad way to think about it. Now that equity could be turning into an opportunity for quite a bit of cash. And so we just want to make sure that whatever you do sell, that you reserve some amount, whatever might be appropriate with some fudge factor aspect for potential tax bills. So you really probably for most clients don't want to have your potential tax monies due in a number of months exposed to the stock market. So we likely want to set that aside in something safe, earning a respectable yield without being exposed to stock market risk and volatility. So we talk about that. So it's not you can't avoid some of these taxes, although some of the things we're talking about can help mitigate. And depending on when the IPO or the liquidity event occurs, if it happens in the first quarter of the year, candidly, it's a lot better than the fourth quarter of the year. It gives us some more choices about how to help a client if it's in the first quarter versus the fourth. Doesn't mean there's nothing to do in the fourth. It just, we have a little more tools in the toolbox that we might be able to explore for a client if it happens early in a calendar year.
Great. Lots of great information here. And for anyone that's listening right now, again, a reminder that you can connect with Jackie and Ryan, first of all, on LinkedIn. But you could also schedule your own complimentary consultation if you go to wealthwithoptions.com/contact-us and schedule your own consultation because we can't get to all of the questions. And I'm sure that, again, if you're listening this on replay, that you have some additional questions of your own that they would be happy to answer. But we appreciate your time so much, whether or not you're joining us live or you're listening to this re-recorded. The Avoid the Biggest Tax Mistakes Tech Executives Make with Equity. Jackie and Ryan, a heartfelt thank you to you for your generosity, sharing your insights and guidance. So many things were discussed on today's webinar. And on behalf of all of us over at Intentionally, we thank you, everyone, so much for spending part of the day with us. We appreciate the time, the engagement, the questions, and we hope that everyone has a great day. Thank you all so very much.